In today's business climate, one reality dominates the conversation. Interest rates are high, inflation is sticky, and U.S. corporations are being forced to reinvent the way they operate to protect profitability. Gone are the days of cheap borrowing costs and endless consumer demand. Now companies face higher financing expenses, slower growth in household spending, and relentless pressure from both shareholders and the market to show strong bottom-line results. So how exactly are America's largest corporations adapting their profit models? Let's break it down. First, let's talk about debt and capital structure. When interest rates were near zero, companies loaded up on cheap debt. They borrowed aggressively to expand, to fund buybacks, or to acquire competitors. But now that borrowing costs are elevated, the game has changed. Companies are shifting from debt-heavy strategies to equity-driven growth and internal reinvestment. Instead of relying on external financing, more firms are doubling down on operational efficiency, streamlining costs, and using free cash flow as the engine of growth. This pivot reflects a broader strategy. If debt is expensive, profits have to come from disciplined execution, not financial engineering. Second, corporations are rethinking pricing power. Inflation isn't just a headline, it directly impacts consumer behavior. Some businesses, particularly in consumer staples and food, have successfully passed higher costs onto shoppers. We've seen giants like PepsiCo and Procter & Gamble raise prices without losing too much volume, but not every company has that luxury. For many retailers, restaurants, and discretionary brands, consumers are pushing back against higher prices. That's forcing companies to explore new profit protocols, smaller packaging, value tiers, or even subscription models to stabilize revenue. The key lesson here is adaptability. In a high-rate economy, firms can't assume consumers will simply absorb every price hike. They have to innovate in how they deliver value while still protecting margins. Third, we have to look at supply chains. Supply chain strategy is now directly tied to profitability. With tariffs and trade tensions flaring again, companies are bringing parts of their supply chain closer to home or diversifying into new regions. This reshoring or nearshoring often comes with higher upfront costs, but it's a longer-term play for profit stability. Businesses are realizing that fragile global supply lines eat into profit far more than the cost of building resilient, localized networks. We've seen this in manufacturing, technology, and even retail logistics. In today's climate, a resilient supply chain is no longer a cost center. It's a profit protector. Next, digital transformation continues to be a central theme. Inflation and higher rates are forcing companies to invest in automation, artificial intelligence, and software systems that reduce labor and overhead costs. Think about banks rolling out AI-driven customer service, manufacturers using robotics to handle repetitive tasks, or logistics companies using predictive analytics to optimize delivery routes. These investments are expensive upfront, but they become critical levers for profit over time. Instead of cutting corners that damage quality or customer experience, firms are focusing on technology that allows them to operate leaner and smarter. Another adjustment we're seeing is the shift in workforce strategies. With labor still one of the highest cost drivers, corporations are becoming more strategic. Some are trimming headcount through layoffs, while others are redesigning roles with hybrid work models that save on office space. At the same time, there's a push toward productivity gains, not just hiring fewer people, but ensuring every employee adds more value through training and technology tools. Businesses are recognizing that in a high-rate world, labor efficiency is not just nice to have, it's a survival mechanism. And let's not forget shareholder strategy. Investors are no longer just rewarding top-line growth. They're demanding profitability and stability. This means companies are shifting toward dividend increases, share buybacks when cash allows, and a more cautious approach to expansion. Capital discipline has become a profit protocol in itself. CEOs, who once boasted about aggressive growth, are now praised for cost management and prudent capital allocation. Wall Street sentiment has changed, and corporate America is responding. Finally, there's the rise of alternative revenue streams. Companies are asking, how can we generate steady, recurring cash flows in a volatile environment? For retailers, it's membership programs like Walmart Plus or Costco. For automakers, it's software subscriptions inside vehicles. For tech firms, it's cloud services and managed platforms. The common thread is this: in a high-rate economy, predictable recurring revenue is more valuable than ever. It's a hedge against volatility and a reliable way to keep profits flowing when traditional business lines face pressure. So when we step back, what does this all mean? U.S. corporations are entering an era of discipline. The easy money decade is over. Profit models are no longer built on cheap financing and passive growth. Instead, they're built on efficiency, innovation, and resilience. From restructured capital to pricing strategies, from resilient supply chains to digital investment, the landscape is being reshaped in real time. For businesses of all sizes, there's a powerful lesson here. You don't need to be a Fortune 500 company to adopt these protocols. Smaller firms can apply the same principles. Focus on operational efficiency, diversify revenue streams, leverage technology, and stay disciplined with capital. In the end, profitability in this new environment isn't about chasing growth at all costs. It's about building smarter, more resilient businesses that can thrive in the long run. And that is how U.S. corporations are reinventing their profit models in a high-rate, inflation-driven economy.